Welcome to this explainer. Okay, today we are laying down the absolute bedrock of your financial literacy. Before you can start writing the complex sentences of double-entry journal entries, you've really got to master the alphabet. So we're going to build up your core business vocabulary so you can understand exactly how wealth is tracked and, more importantly, how it's grown.
Let's take a quick look at our roadmap. We're going to go beyond the boring ledger, set up Raju's Pani Puri stall, run some daily operations, track the score, dive into the master accounting equation, and finally, wrap up with a fin ecology knowledge check.
All right, part 1, beyond the boring ledger.
So for centuries, accounting was basically just clerks tallying up past trades, right? But today, it's this incredibly dynamic information system. Just look at these exciting growth areas. We're talking about forensic accounting, where professionals are literally solving computer hacking and tracking down internet thefts. You've got accountants designing massive e-commerce payment systems, shaping financial planning, and even pioneering environmental accounting to track ecological footprints. But hey, before you can fight financial crime or save the planet, you absolutely need to know the basic terms.
Number 2, setting up Raju's Pani Puri. Let's learn that accounting alphabet.
Okay, the very first concept you absolutely must grasp is the entity. An entity has a definite individual existence. What this really means is that Raju Pani Puri Center is treated as a completely separate legal unit from Raju himself. It's like a solid wall exists between them. So if Raju buys a new shirt for himself to wear on the weekend, that is definitely not a business expense. The accounting system we're building is strictly for the business entity itself.
Right, next up is capital. This is the initial money, and even physical things like the cart that Raju brings from his own home to start the stall. Now, because of that separate entity concept we just talked about, the business essentially owes that capital back to the owner. Kind of wild, right? It's actually viewed as an obligation or a claim on the business's assets.
And that perfectly brings us to the great divide, assets versus liabilities. Think of assets as everything the business owns to actually run its operations, like Raju's shiny steel cart or his big stock of potatoes. Liabilities, on the other hand, are what the business owes to outsiders. So if Raju takes out a 10,000 rupee bank loan to buy that cart, well, that obligation is a liability.
Now, we can split those assets into two main categories. Non-current assets are your long-term workhorses. Think of Raju's heavy-duty stove that's going to last for years. Current assets are highly liquid, meaning they're consumed or turned into cash pretty quickly. This includes the daily cash in the drawer and his stock, or inventory, which is basically the unsold puris and unpeeled potatoes sitting there at the end of the day.
Moving on to part 3, running operations. Let's look at the daily flow.
So, day-to-day operations are made up of transactions. These are events involving some kind of value exchange between entities. For Raju, this whole thing revolves around his goods, which are the actual pani puris and masala water he deals in. Every single time he buys wholesale ingredients or sells his goods to a hungry customer, an economic event happens, and we have to measure that in money.
Now, when money flows into the business, we call it a receipt. But there's a catch. A capital receipt actually creates an obligation, like taking out a big long-term loan to expand the stall. A revenue receipt, on the other hand, comes right from daily operations, and you don't have any obligation to return it. For Raju, the total cash he rakes in from customers for selling his goods, that's his revenue.
The exact same logic applies when money goes out, which is called an expenditure. A capital expenditure is a major, long-term investment, like buying a brand new commercial refrigerator. A revenue expenditure is a short-term cost that's consumed almost immediately. These short-term costs that you literally have to incur just to earn revenue, like paying rent for the stall space, the electricity bill, or helpers' daily wages, these are specifically known as your expenses.
All right, part 4, tracking score. It's time to determine the true profit.
To track the score accurately, we really have to account for timing differences. I'm talking about things like outstanding expenses that we still owe but haven't paid yet, or accrued income that we've totally earned but just haven't received in the bank. Sorting this out helps us calculate the true profit, which is the excess of total revenue over total expenses in a given year. And hey, just to be clear, that's very different from a gain. A gain is more like a random one-time win, like if Raju manages to sell an old beat-up stove for way more than it's actually worth.
Now, sometimes things just don't go to plan, which brings us to debtors and creditors. A debtor is someone who owes the business money. Let's say a regular customer comes by, eats 5 plates of pani puri, but promises to pay Raju tomorrow. That customer is a debtor, which is actually an asset. A creditor is someone Raju owes, like his potato wholesaler. And look, if a debtor totally bails and refuses to pay, it officially becomes a bad debt, which is recorded as a straight-up loss for the business.
Section 5, the master equation. Assets equal liabilities plus capital.
Behold, the fundamental accounting equation. Assets equal liabilities plus capital. Basically, it means that absolutely everything the business owns on the left side, Raju's cart, the potatoes, the cash, was funded by exactly two sources on the right side. It was either funded by money borrowed from outsiders, like a bank loan, or by Raju's own personal savings. We call this the duality principle. Every single transaction has a twofold effect. So if Raju buys a new stove using a bank loan, his assets go up for sure, but his liabilities go up by the exact same amount. It perpetually balances the claims of outsiders and owners against the resources of the business. It's like a perfect, unshakable mathematical scale.
And finally, Section 6, the Finecology Knowledge Check. Let's test your understanding.
Okay, we've defined Raju's operations and covered a lot of ground. So let's see if you can select the correct foundational concepts based on what we just discussed.
Here are 3 quick questions to test your grasp on the material. Question 1. Accounting produces financial statements over a lifetime in accordance with which concept? Question 2. The concept that a business won't be sold or liquidated in the near future is known as what? And question 3. Assets equal liabilities plus what? Take a quick second, think it over, and lock in your answers.
All right, let's see how you did. For number 1, financial statements are produced according to the C accounting period concept, which is usually done annually. For number 2, assuming a business is going to stick around and not close up shop is known as the A going concern concept. And for number 3, our master equation dictates that assets equal liabilities plus B capital. Mastering these terms is an absolute game changer. It ensures a totally smooth transition when you start writing full journal entries. Remember the golden rule here. In financiology, we don't just learn terms, we learn to identify our assets so we can actually grow our wealth. We've mastered the letters. We've built the foundation. So I'm going to leave you with this thought. How will you apply the duality principle to your very own personal balance sheet tomorrow? Seriously, look at what you own and ask yourself, who really funded it? Thanks for joining me on this explainer and keep building that financial literacy.